Now we get to pivot into the Chinese markets. So it's interesting because when you look at, coming off of the European commentary, we talked about how the ECB is holding tight on policy, and again, things are getting more volatile, and it's not surprising to see things within China. When you look at the 5-year loan prime rate and you look at the 1-year prime rate, things were held consistent. So you're seeing some consistency, and then anybody that has cut rates, and we'll talk about this on Friday, you've started to see some rate increases because there's still a bigger problem when you look at underlying flows and inflationary pressures. And one of the key things within China, the SWIFT global payment system, slightly better. New home prices have come down. But then you look at FDI. So foreign direct investment to date, last month was negative, or I should say, in August was negative 5.1%. In September, it was negative 8.4%. So you're still seeing those pressure points to the downside. So the Chinese economy needs to grow by about 5% in 2024 to signal that the nation's development is stable and healthy, a former Chinese central bank official said. Several other economists cited in this article seem to agree. But the problem is, how do you achieve that? Because we've seen more pressure on the housing front, which is going to pressure the consumer. As we talked about in segment 1, we don't see a benefit on the trade front. So how do we see these things, happening in general? And I don't think that we fully appreciate what a strange way that they think about economic growth. So rather than work out how much growth a stable and healthy Chinese economy might be able to deliver given high debt, the property crisis, which is ongoing, we had another rolling default, weak domestic demand, global headwinds, and other conditions that are specific, obviously, to the Chinese economy. These economists have reversed this process and are determining what would be politically acceptable growth rate and then calling for the spending policies needed to achieve. And as we've talked about on the green agenda and a lot of these other things, target-based economics never works because you ignore everything that you're trying to do to get to that point. So now you're seeing these pressure points, you're seeing these underlying issues in general. So again, these are some of the key issues that we continue to face in general. So as long as there is debt capacity, there can always be some more investment, but even if that investment doesn't increase the real value, but that's a problem that they've been adding to. And as we looked at law of diminishing returns, we see more pressure when you start to see that again, good money after bad, negative multiplier impact. Whenever this has happened before in other countries, the signal usually was ignored, that high growth was not sustainable, was that investment-related debt grew much faster. So again, they can't repeat these same mistakes, which they're essentially starting to do when you look at how that new spending or that new deficit spending is going to be. It's back towards infrastructure. And again, there's not a lot of infrastructure still out there that would yield a meaningful return. So China's M1, M2 ratio and the proxy for household marginal propensity to consume continues to fall. And that's not something that we see changing. So the projections for Chinese GDP growth year over year has continued to move down. This is something when you look at that growth side, we just think that things are still too lofty for 23 and 24. But overall, as just again, large numbers, it's easier to, if you were to grow from 1 trillion to 5 trillion, that's a meaningful jump. But to go from 5 trillion to 10 trillion, it's a bit harder. So again, the inherent size is going to whittle down on just the amount of growth that's achievable. But the economic debate before the third plenum is getting more heated, with a former aide to Liu He seemingly very worried about the current path that Beijing is taking. So in a recent interview, he has expressed concern over the slow pace of Chinese economic reforms, arguing that the present combination of macroeconomic policies, monetary tweaks, and expansionary fiscal moves will not be sufficient to revitalize the country's growth prospects. But we have to look at what was driving the growth. It was real estate. So that real estate level can't really continue at that current rate because it was unsustainable given the practices of the developers. Not to say that it can't after a shakeout, continue on an expansionary growth. It just has to be more of a normalized growth basis. The issue is how that impacts consumer spending, because the consumer was grossly overexposed. So that's going to take time. So you have to find ways to try to drive the consumer in terms of those safety harnesses and some of that additional spending. But when you look at FDI slowing, businesses taking jobs out of China, were creating underlying problems and additional expansionary issues. Now, the Yang, now Deputy Director General of a government-affiliated think tank, some hard reforms are yet to be carried out, and others are so controversial that there is not yet any implementation plans for them. He also said that the third quarter rebound was a shallow V-shaped one, adding that the prospects for next year continue to be haunted by a debt debacle, trapping developers and local governments, and faltering confidence from the private sector. We believe that that's happening now as well. We agree 2024 is going to be a problem, but one of the things that we didn't mention before that we can mention here is that the interconnect. So we talked about the interconnect between retail pricing and the consumer. There's also a massive connection between retail prices, real estate pricing, and local governments, and that's the multiple layered issue, which is why we've said that there's so much over leverage on the same asset, and then that asset has actually been used on multiple occasions for collateral, which again, layering more problems on top of other problems. Over the next few days, we may get a chance to see more public airing of some of the concerns that are mostly expressed privately among economists. There seems to be a growing sense among economists and economic policy advisors that the Chinese economy needs deeper structural reform than have yet been implemented. And again, those are things that are going to take time to play out, which is why I still think that there's way too much expectations for not only this year, but also next. You know, the U.S. versus Chinese economy in U.S. dollars, you get an idea of the differentiating factors. And one of the things that we've said is, because people like to point to, oh, well, the U.S. debt bubble is huge. It is. I'm by no means saying it isn't. But when you look at raw numbers, it's misleading, because an economy that's 27.1 trillion can carry more debt than an economy that's 17.4 trillion. So on a net numbers basis, the US debt is going to be higher, but the percentage and the leverage ratios are worse within China, which is something that I think sometimes people in the market miss. The PBOC increased lending to banks by a renminbi 2 trillion in August and September. And that's that management that we've talked about on the credit impulse side. They're trying to keep it at about zero, and things got a little bit too low, but it's really hard to just hold it at zero because there's ebbs and flows in it. So they tighten, then they put more in, and they try to manage those underlying pressure points. And they've stepped up the support by expanding its balance sheet via liquidity facilities, OMOs, and relending tools. In the past 2 months, the central bank has increased that. But it's important to weigh that against where are underlying flows. So the Bloomberg Economic China Credit Impulse mid-price, you can see again tightening at that 24.9. But then when you look at the 12-month net change, you're still negative. And that's what they've been trying to do is we've been saying stay between 0 and negative 1%. They're at negative 1.43%. So again, there's some expansion capacity, but because of the strength, if you will, and this is, strength is obviously a relative term, the Chinese economy finds itself in a difficult spot because it's not in a recession and it's not at 5%. Let's say the Chinese economy is between 2 and 3%. That's not a position that you can find yourself and say, oh, we need a ton of stimulus. It's like, well, not really. You need some protection, but not a huge amount, which is why the market, and this is what we had said back at the end of last year, the market was expecting this huge push of new stimulus. Then you had the end of COVID, zero COVID. Everybody expected this massive rebound number that was going to last through 2023. We said it was going to be a flash in the pan, but it wasn't going to be enough to need stimulus. So again, we were right. And then as things weaken, everyone's like, oh, stimulus. It's like, well, No, because it's not going to get to the point where you're going to need a lot of stimulus. And again, this is kind of that ebbs and flows where we try to be more measured and help people understand the intricate natures of things. Chinese economic momentum and PBOC injection, again, carrying that momentum higher, because when you look at the GDP momentum, you can see it's still negative momentum. They're trying to drive some of that, but within reason, because they still have a lot of liquidity out there. China sells most U.S. securities in 4 years, and it's because they're trying to stabilize the economy. They're trying to offset the loss of natural dollars coming in from exports. Then you have the other side of, they have a FX reserve issue. Well, how do you rectify that? Pull dollars in, sell some of your treasuries down. These are things that it's not malicious. It's them trying to manage their system to try to figure out where things are, because realistically, you want to buy more U.S. treasuries at these prices because they were buying them when they were terribly priced. So again, they're actually losing money on these sales. So this is a key piece where they're doing it as a means of managing their internal system, and less because they're trying to directly hurt the U.S. China residential commercial building transactions continue to be low. We don't see this recovering. It's just having seasonal moves, just obviously at a much lower rate. Pre-sales continue to be very disappointing. Again, not something that we see changing, which is going to be a problem for the real estate sector, especially because they rely so heavily on those numbers. Newly started residential real estate, again, continues to fall flat. And unfortunately, 2022 was low comparison, and this is even lower, which is why, there's been a bit of a pivot to, well, we need some sort of growth trajectory. So they're now, trying to re-engage with the public sector, with the private sector. But geez, private sector love, again, it's kind of lukewarm. It's not like they're going after everything, but they're trying something. And the All China Federation of Industry and Commerce, which represents private businesses, held an event to celebrate its 70th anniversary. Wang Huning, chairman of the National Advisory Body and China's fourth-ranked official, showed up and made a speech. Xi sent a congratulatory letter. As far as as Trivium can tell, that makes it the highest profile celebration. Xi letter put a dampener on things, or I hope that people in the private sector will strive to be law-abiding models of patriotism, dedication, entrepreneurship, innovation, and will repay society. So again, that's a very communist thing to say, if you want to put it that way. It's like, well, patriotism, which I remember is CCP based, dedication to the party, and repay society. So again, it's a bit, they want to support it. We're going to show a level, but there's only so much we're willing to do, which is, I think, still gives people pause when you look at some of these underlying factors. Sales manager index for manufacturing rolled over a bit. Sales manager index for services fairly flat. So again, as we've been saying, manufacturing was going to bounce, but still, remain a bit tighter. We saw that. Services is going to remain fairly stable. You're seeing some of that movement. So Zhao says that Brussels shouldn't complain about the lack of access to Chinese markets. The fact is China's trade surplus is the result of the interplay of market forces. So you're looking at some of the pressure now because people are calling on China to be more, quote unquote, fair and competitive in trade. But we've seen time and time again, like look at the US. There was a lot of companies that said, we'll give them the deal they want because we'll make it up in volume. And it never materialized. And now people are wisening up and starting to pull out, and it's putting more pressure on Chinese bilateral trade. And the U.S., which is why we've talked about, when you looked at the Trump and China, the U.S.-China trade war during the Trump presidency, that was a natural progression of where things started with Obama and was continuing down. And I think others are going to see themselves on the wrong side, and you're going to see more pressure, which again is going to minimize FDI and keep pressure on FDI because it's like into China, because it's like, well, let's go find a friendlier nation, someone that's nearby, and will be more balanced if you look at some of these underlying views. Estimated local government debt burden in China, a percentage of gross domestic product. continues to drift higher. And that's what the problem is, especially when you look at the major source of local government funding is, the land sales have come down. So subsidies and transfers for Beijing, because they're trying to, again, move that money down. As tax revenue continues to fall, they're going to need more subsidies from Beijing, and their debt burden is getting worse. And so, again, leveraging further is not going to benefit anybody given their current backdrop. Chinese bond yields and interest rates continuing to drift higher. And when you look at the LGFVs, because again, we see these getting more pressure, because at what point does Beijing say, we can't continue to throw this money after these areas, especially as interest payments as a percentage of fiscal capacity expands higher, just because there's risk in some of these entities, and you've seen that overarching shift. And as they look to roll that debt, it's going to become even more expensive. So land sales and local government financing vehicles, a year-over-year change. Again, continuing to see that pressure on the bond issuance is increasing, because they're trying to just roll that debt or issue new debt to finance the previous one, as they can't get any of that money from the property sales. Chinese FDI continues to move down. And it's interesting because when you look at the Chinese cumulative year to date, the FDI is coming down. But when you look at the U.S., and it's interesting because, and this is where we want to make some connections, because when you look at existing home sales in the U.S., you look at year to date U.S. existing home sales in the U.S., it's not just China that has a housing problem. And again, we point to them because it's front and center. They're going through their debacle that we went through, not so dissimilar in 2008. Obviously, it was different in a lot of ways, but again, there's a lot of unwinding that's going to happen, and that's why we see this longer-term projection of slowdown and pressure, because we don't see a lot of that fixing in the near term. Sales volumes across the retail subsector, when you look at where things are in September, you can see that things slowed down on the retail apparel side, especially on the food. But, it was still better than last year, but it was slower than August. And we saw that, September was still good, but October got a bit worse. And that's where we see some of those pressure points continuing. Beijing seems increasingly serious about addressing the fiscal growing financial risks. Good news if it leads to policies that reduce further non-productive investment, but we've already seen that they're going to increase non-productive investment. The hard part is that these policies will necessarily result in slower growth in the near term, which is likely going to happen. But China's track record has never been to consume its way out of slumps. Retail's failure to soar in 22 and 23 can't be surprising. And that's what we've been saying, is that like sales volume, when you look at it in general from Q3 was a bit slower than Q2. But we see that continuing into Q4, and it's not that it's going to collapse. It's just that's not where things are, especially as there's more pressure that remains on the consumer. So then when you look at more than half of China's former top 50 developers have gone into default. So when you looked at missed payments and then outright default, Country Garden is the latest victim of the China's property crisis starting in 2021. And it's just going to expand because they have this haphazard process of trying to go after it. And Country Garden is the newest one to fall. And it's not going to be the last because there's so much exposure out there. And then the problem is, as these default, well, how many of these assets had double, triple collateralized the same asset? What is the exposure of the local government to them? These are problems that we continue to see in general. Property sales plunged for largest developers such as Evergrande and Country Garden. Home prices fall in most Chinese cities in the past 2 years. And again, these are not only negatives for the banks that backstopped them and the investors that backstopped them, but also the investors that backstopped them. A lot of them were local Chinese consumers, not just, Blackstone. It's much bigger and much broader than that. And I think a bigger issue in general when you look at the recovery rate, because we're not seeing recovery. There's still more pain to come. There's still going to be more defaults, and that's going to take time to shake out. Developers still need to complete a huge amount of construction because, if you're an investor, you prepaid and now or if you're a homeowner, a potential homeowner, you prepaid. Now your recovery of an uncompleted or not even started unit is going to be difficult, which is why until you have some meaningful appreciation or at least see this asset, it's unlikely that you're going to get this big pickup in consumer spending, which is why when you look at the Hang Seng Mainland Property Index, it's down and it's unlikely to see much of a bounce. Now, when we look at Japan's 10-year bond yield continues to move higher, the 40-year as well. And it's because when you look at the yen is still over 150. We do think now that it's broken 150, it'll likely move fairly rapidly to 160. And it's going to be because the BOJ is not going to give up on that 1% target or ceiling, I should say, for the 10-year. And that means that in order to do it, they're going to have to buy the 10-year and dump those yen into the market, pushing up that pressure. And unfortunately, it's all going to end poorly. It's just going to be a matter of when do they let it end in some meaningful way. All the while, how that connects in is China's banks sent biggest amount of funds abroad on behalf of clients because people are like, look, I want to get out of the Asian market because there's likely going to be some contagion coming from Japan into China. So people are like, we need to diversify, out of this region, PBOC net injection via reverse repo, again, trying to protect this market. And yes, Japan and China are in a similar region, but you have to look at their interconnected nature and how the investors will view contagion, especially when the fourth largest economy starts to default or starts to struggle, then how much exposure do you want within Asia? There is a certain amount of back and forth that exists between the Chinese and Japanese markets. The CNY first 1-year interest rate swap continuing to move higher. The China bond curve, again, remember, shifting up because there's that fear. And we do expect this to continue to shift higher, especially as not only U.S. rates go up, but also more pressure remains in Japan. And that underlying reason, which is why CNY forecast versus official fix, they're constantly trying to defend their currency, which is the knock-on from that shift away from the Asian markets with not a small amount to do within the Japanese markets. So then you look at Korea, imports were expected, were at 0.6. Exports for the 20 days were at 4.6. Remember, import, that leading indicator. PPI came higher than expected at 1.3%, which is a bigger problem when you look at that reacceleration of inflation as consumer confidence continued to wane. And then the business survey for non-manufacturing and manufacturing got a bit worse, while GDP came in slightly better. But again, the issue is not so much was Q3, but what's happening as you go into Q4, because it takes time, especially given the amount of exports that have fallen, the continuous slowdown on the exporting global market is going to continue to hit harder within the South Korean economy. Japan national CPI came in at 3%. Ex fresh food came in at 2.8% with some of those accelerations. PMI composite, it came slightly into contraction driven by manufacturing. Services continue to slow. We see that continuing to fall as well. Again, services we do see going into contraction. PPI for services went up. Again, more of that backdrop for additional pain points as machine tool orders came in at negative 11.2%. Again, confirming more pressure on the manufacturing side as that continues and then again bleeds out into the service side as well. South Korean exports, as you can see, typically they drop, but you see the drop was a bit stronger. We do see more pressure here and coming closer to where we were in 2022. Especially given, and again, some of the leading indicators using those import side, the survey and manufacturing and non-manufacturing, again, that slowdown in general, and just showing a bit of that pause, which isn't surprising given the pressure within the Asian markets. We focused a lot in China, but obviously there's ramifications to that. There's knock-on, South Korea just being one of them as well, as Japan continues to see their rates go up, especially on the food front, which is something that Japan is really trying to go after, finding ways to adjust their food import inflation because they rely so much on imports. They're trying to source more fertilizer internally at cheaper prices, and trying to rejuvenate some of their soils that have been abused over the years. Japan's CPI, again, staying elevated. And this is where you look at import prices in general. And it's just the pressure remains when you look at these underlying issues. Import prices have come down, but again, goods in general continue to go up, driven based on some of this monetary policy. You know, the government bond yield is moving up as much as they'll allow it, and we do see that continuing. They're still maintaining that negative rate at the front end. As Japan's service PMI, again, PPI, all of this showing additional pressure, which is why we see this getting a bit worse. As you see their economic growth slowing, it's going to put only more pressure on the economy. As the economy slows, that debt to GDP looks worse. And again, we do see yen upside as they try to maintain and protect that yield curve, which is, again, investors are just pushing against that string until they finally yield. So that's what we have for you on the Asian side. You know, hopefully this was helpful. If you have any questions, please let us know. And we'll talk to you tomorrow during the Frac Spread Count show. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.